Gold is the so-called BRICS currency. They're not going to put together some magical basket of the five of them nest, and they can't get along all the time. Nobody needs to with gold. And so, when you see Brazil buying a lot of gold at the central bank level, don't lose sight of what that means. That is oil and commodities for gold.
The central banks would revalue gold much higher so that whatever they lost in the devaluation of their currencies, they would recover through the upward revaluation of gold. That always struck me as a very plausible outcome. And I think there's certain things that are happening suggesting this is already underway, as McGuire says.
The global monetary system is showing mounting tension as sovereign debt levels collide with a world rapidly shifting toward hard asset settlement. Rising bill issuance, stressed repo markets, and the expanding reliance on short-term funding mechanisms reveal a structure that is no longer able to stabilize itself through traditional policy tools. As liquidity fractures spread, capital is again searching for assets that cannot be devalued at will, pushing the conversation back toward gold's strategic role at a moment when geopolitical blocs are openly repositioning for a post-dollar world. Luke Gromen, a longtime macro analyst recognized for his work on global funding cycles, and Chris Powell, a researcher known for decades of investigative work on gold market structure, outline a system approaching a critical juncture. The accelerating gold accumulation by nations like Brazil, the growing likelihood of revaluation as a debt resolution tool, and the shift in reserves away from treasuries highlight how quickly priorities are changing. In parallel, the U.S. faces a funding loop in which enormous bill issuance fuels a rising Treasury General Account, pushing repo rates higher and stressing highly leveraged hedge-fund treasury trades. The standing repo facility is now acting as a stabilizer of last resort, an early form of yield curve control signaling that the next phase of balance sheet expansion may already be forming. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Brazilian central bank sure has been buying a lot of gold, haven't they, in the last few months? Significant amounts of gold. And I think that's an important clue, in my opinion. Have been saying for a long time, continue to say it, gold is the so-called BRICS currency. They're not going to put together some magical basket of the five of them nest, and they can't get along all the time. Nobody needs to with gold. And so, when you see Brazil buying a lot of gold at the central bank level, don't lose sight of what that means. That is oil and commodities for gold. And the oil market alone globally is 6 to 8, maybe 10 times the size of the global physical gold market in annual physical production terms. And if the U.S. wants to reshore, treasuries cannot be the primary reserve asset of the world anymore. They just can't. The U.S. is literally basically printing money to buy commodities, make investments in commodities and hard assets. And it's the right thing to do. Don't get me wrong. But if you are everybody else, if the Americans are printing dollars, printing treasuries to buy commodities, you can't store the wealth of your country, the surpluses from your country, in treasuries anymore. You have to go to something else. And the only other thing there is gold, which is why gold just surpassed treasuries in global FX reserves for the first time in 30 years. And I think within probably 1, 2, maybe 3 years, given continued central bank buying of gold and price rises of gold as commodity markets that are way bigger than gold markets bid gold higher and central banks keep buying gold, I think gold is going to be bigger than the dollar in global FX reserves within 2 to 3 years. And that's going to be a real interesting moment of cognitive dissonance for a lot of discussions. And that's okay. I don't care. I own gold. That's what it matters. My clients own gold. That's what we're after. Equity volatility would then trigger forced long-term treasury selling from highly levered hedge funds engaged in the basis trade, many of which are based in the Cayman Islands. They have, according to a recent Fed white paper, bought 37% of long-term treasury issuance since January 2022. So you've got higher bills, higher T-bill issuance because you have to, because you can't term it out without creating equity vol. You've got, as a result of the higher bill issuance, that mechanically drives a higher Treasury General Account, or TGA, which is just Treasury's checking account. That's just for cash management purposes. The more bill issuance is, the more there's more refinancings coming due, the bigger that has to be just mechanically out of policy. But now the higher TGA is driving higher repo rates. because the TGA, given that reverse repo has been run down, TGA is starting to crowd out overnight funding rates. That threatens to pressure the funding side of the hedge funds we just talked about that have bought 37% of net issuance since January of 2022. They fund in repo and they're levered anywhere from 50 to 100 times. They own in total, according to the Fed white paper, $1.8 trillion in treasuries. They are said to be at $1.8 trillion by way of comparison. That would be nearly, that'd be 70% more than Japan's holdings. It would be nearly triple China's holdings of treasuries. So they are by far the biggest foreign creditor of the United States. And so if equity vol picks up, these guys have to sell. TGA is up because we're funding so much in bills, in part to avoid issuing so much at the long end because it might trigger equity vol. And so we have to have a higher TGA because we have so many more bills rolling every week as a result of that policy decision. And now the higher TGA is forcing repo rates higher, at least putting upward pressure on them, which is the funding side of that same group of hedge funds' long-term treasury purchases, the basis trade. Now, all of that threatens a chaotic unwind. And that's where the standing repo facility from the Fed comes in. It has been tapped in the last couple of weeks, a couple times. It's actually rising again today as I record this on Thursday. The Wednesday data was up a bit. It was tapped for $6 billion, which is not that much in the grand scheme of things. But the standing repo facility is there to reduce repo stress. It was put in place after the 2019 repo rate spike. So the standing repo facility balance rising pushes repo rates back down to targeted levels. That's just like yield curve control. That's all yield curve control is, except it's at the front end and it's on a more spot basis. In my view, that is stimulative because that is ultimately the standing repo facility, the Fed's balance sheet, funding deficits on the margin because we're issuing bills to fund deficits on the margin. So eventually, to your question, maybe there is some other balance sheet growth that could take place. Perhaps there's other metrics, some source of funds, maybe stable coins, maybe at some point down the road, they can revalue gold and buy down some of the debt. But ultimately, it's the treadmill is higher bill issuance because they have to, higher TGA because the bill issuance we've been running crisis level of bill issuance for 30 straight months now. So it's coming faster and faster. Higher TGA without reverse repo balances to run down, et cetera, means you start to crowd out repo. Repo rates threaten the funding side of the basis trade. That can't be allowed to happen. Standing repo facility mitigates those pressures, brings repo rates back into targeted levels. Wash, rinse, repeat as we keep on going from here. So it's going to be interesting to watch, that's for sure. And I think people are starting to kind of gather and put these stresses together. From Gail, I would be interested in your thoughts on this. The White House says October jobs and inflation data may never be released. If it was good news, it'd be released, wouldn't it? In my opinion, it's more sign of another signpost of Banana Republic-like action. It is what it is. It's basically a buy gold and buy Bitcoin advertisement, in my opinion. But from Brent, hi Luke, follower and subscriber. Thank you very much for your business. I appreciate you. Like hearing your views and opinions, always thought-provoking. How would you advise or maybe precaution retirees that are dependent on a 401k that has all stocks and ETFs other than the 20% diversification into gold and Bitcoin? If I was a retiree, for me, when you think about gold and Bitcoin, if I was a retiree, Bitcoin's volatility is just so high. I don't think it should be a very big part of a retiree's portfolio. So if you're talking about a 20% to gold and Bitcoin, 1 to 2% to Bitcoin, the rest in gold. But I think it needs to be physical gold. And I think the Bitcoin probably needs to be self-allocated. And look, if self-allocated or self-custodied Bitcoin, is too intimidating for a retiree, which is understandable, all gold is fine. But I do think on some level it's becoming critical to have some physical gold as a retiree. And if you need to sell some long-term bonds within your portfolio to do it, I would absolutely do that. What I was just talking about with this treadmill before is a sign of increasingly acute funding/fiscal stress, fiscal dominance in the United States. That's not deflationary over time, full stop. That's a type of action that as a retiree, if you're in long-term bonds, takes you from eating steak to eating hamburger to eating dog food, unless you have some gold. That's why I say it's critical. For me, I would highlight 3 ETFs. I have no interest in any of these in terms of just financial compensation. I'm not a spokesperson for any of them, and I would do your own due diligence as always. But if you look at PAVE, P-A-V-E, GRID, G-R-I-D, and VOLT, V-O-L-T. Look at the 3 of them. Look at the components of the 3 of them. Those are the types of names that I think you want to be exposed to benefit over time from reshoring and from electrification.
The accelerating discussion around gold revaluation reflects growing recognition that the global monetary system is drifting toward a reset point. Recent market patterns, especially the steady, step-like rise highlighted by long-time market observers, suggest that a coordinated revaluation may already be underway. Central banks appear to be positioning themselves ahead of a significant currency adjustment, quietly absorbing physical reserves while allowing the official data to remain opaque. Decades of suppressed pricing, unreported leasing, and derivative overhangs have left the physical market dangerously oversubscribed, and the repatriation trend signals an apparent loss of trust in external custodians. As deficits expand and money creation becomes detached from economic output, the gap between circulating currency and tangible assets is becoming increasingly difficult to ignore. A structural repricing of gold would not just repair sovereign balance sheets, it would redefine the financial order for decades. Now, let's get back to the interview.
The talk of revaluation of gold, of course, gold owners love to hear talk about revaluation of gold. Andrew Maguire, who's the London metals trader for Kinesis Money's Live from the Vault program, several times has shown gold price charts suggesting that gold revaluation is already underway, that gold has been rising in the last year in what Maguire calls a stair-step pattern. It goes up and then hangs at the stair step for a few weeks, then goes up and hangs at the stair step for another few weeks. Maguire says the gold revaluation is already underway, and it's very possible this revaluation is being coordinated among all the major central banks, that they're already in on it. The U.S. economists Paul Brodsky and Lee Quaintance did a paper, I think about 12 years ago, saying that us gold bugs should stop complaining about price suppression, that the real central bank game here was to hold the price down long enough so that gold reserves could be distributed among the major central banks, so that all the major governments would be hedged upon the inevitable devaluation of their currencies. Brodsky and Quaintance said at that point, central banks would revalue gold much higher so that whatever they lost in the devaluation of their currencies, they would recover through the upward revaluation of gold. That always struck me as a very plausible outcome. Jim Rickards, I think, from time to time has gone back to make calculations on the basis of what gold would be if it had say a 25% or 30% cover against the dollar, but it would be many thousands of dollars above where it is today, however you want to calculate it. The government currencies, especially currencies that were not directly tied to gold, would depreciate in the face not just of gold, but in the face of all physical assets. Prices would very possibly rise dramatically. That would be a hell of a problem for ordinary people. If a loaf of bread, instead of costing $3 today, it was costing $15 tomorrow, where's that extra money for ordinary people going to come from? I just don't know, but they've got themselves in a real box here by really untethering currencies from gold. I mean, money creation has gone stratospheric. The U.S. national deficit is like $38 trillion, and it went up $1 trillion, I think, just in the last 6 months. Where has that money come from? It's just been typed in. It's been, printed and distributed. There's very likely going to be a dramatic adjustment between, money in circulation and hard assets. Gold is the once and future money. People, particularly governments, have seen that the U.S. government can't really be relied upon as a custodian of financial assets. The Russians learned that hard lesson a couple of years ago. That has put trust in the U.S. government in question. Governments have repatriated gold from the Federal Reserve in a gradual way for the last few years. The Russian incident has shown them that you can't rely on the U.S. to be custodian of your assets unless you're going to take orders from the United States in foreign policy. I think governments and central banks have realized that your foreign exchange reserves are safe only when they are in your own hands, in your own vaults, in your own country. And that, I think, is building a consensus that gold is still pretty good money. And insofar as it is money without counterparty risk, it's the best money. We have been pointing out for years that official gold data is useless. The secret March 1999 report of the staff of the International Monetary Fund was very explicit, saying the IMF was going to refuse to let central banks distinguish their gold in the vault from their gold out on loan, because if the markets knew how much central bank gold was leased or swapped into the market, then the market would know just how able central banks would be to continue to intervene against the gold price. So the secret March 1999 report of the IMF staff admitted that the official gold reserve reports are fraudulent. They don't distinguish the leased gold from the unencumbered gold. Saudi Arabia was caught, I think, 10 years ago not reporting gold reserves to the IMF in its full complement. China is estimated, well, I guess China has said it's got something like 3,000 tons or thereabouts official reserves in the account of the People's Bank of China. But the import data suggests China's gotten far more gold than that in the last decade. They're, reasonable experts have estimated that the real Chinese government gold reserves are in the tens of thousands of tons. Certainly that insofar as China now is offering to vault sovereign gold reserves and is trying to internationalize the renminbi, gold is very useful to them in that, and they probably have something like 40, 50, 60,000 tons, and with that amount of gold, they can remonetize gold around the world, which I think is their plan, because nobody's going to trust the currency issued by a totalitarian government. But you can test the gold that you take from a totalitarian government, and you can see that money's going to be pretty good. I think gold is the financial mechanism that China is going to use as a counterbalance against the United States. Well, it would tend to strengthen the Chinese currency and weaken any currencies that are not tied to gold. Now, I don't know exactly how China would so-called, how China would have so-called backing for gold. Would it be a fixed exchange rate, be a floating rate? I don't know, but look, the Reserve Bank of Australia used to put in its annual report a very candid explanation as to why central banks hold gold reserves. The Reserve Bank of Australia said in its annual reports that gold is held for currency intervention. And I don't think anything about that has changed. If China is acquiring more and more gold, it's for currency intervention. If the United States, anybody else is acquiring it, it's for currency intervention. If the United States still has 8,133 tons of gold unencumbered, it keeps that gold for currency intervention. That's, I think, what gold investors got to understand, that the gold is both the playground and battlefield of central banks. You can't examine gold at all without understanding that it is a central bank weapon. This was really the suggestion of the disappearance of President Trump's interest in auditing the gold reserves at Fort Knox. I mean, back in February and thereabouts, we had weeks of this sensation. He and Elon Musk wanted to audit the gold reserves at Fort Knox, and Trump said he'd be very upset if the gold wasn't there. And then suddenly there was no audit, but they just stopped talking about it. And Brian and others began to suspect that somebody, an adult in the room, possibly Treasury Secretary Scott Bessent, took the president and Elon Musk aside and said, listen, you ought to really knock off this Fort Knox audit business until we can get our gold reserves back in unencumbered shape. And I think that's a very plausible explanation for some of the great physical demand in gold that has manifested itself in recent months. It's very possible the United States is putting some gold back where it was supposed to have been all along before we try any audits. Well, a few weeks ago, the Bank of England had to publicly explain the delays in moving gold out of the Bank of England. The Bank of England vaults gold for bullion banks, not just official organizations. And the Bank of England said it was having trouble unloading all this gold from its basement that was being delivered because of logistical reasons. Deliveries were behind, and the Bank of England said, well, we just can't get it out of the basement fast enough. Look, for all we know, the U.S. government could be vaulting gold with the Bank of England. We've done that before. During the London Gold Pool in the 1960s, the United States helped operate the London Gold Pool by shipping U.S. gold reserves over to the Bank of England. So there's always a shell game going on with gold. You never know where all of it is at one time, and how much duplication, overcounting of gold reserves there is. But we do know that there are thousands of tons of derivative gold, paper gold, that doesn't exist. And I always have wondered if the Secretary of State would take the British ambassador to Fort Knox on Monday and say, hey, look at your gold. And on Tuesday, he'd bring the French ambassador and show them the same gold and say, look at your gold. And then the German ambassador on Wednesday and so forth. The actual physical metal long has been oversubscribed.
It's interesting. It's such an interesting topic of debate, of course, at the gold side. What are some of the angles that we haven't explored yet for gold? Like what else is keeping you busy? What are you following closely?
Well, I'm following closely the talk of revaluation of gold. Of course, gold owners love to hear talk about revaluation of gold. Andrew Maguire, who's the London metals trader for Kinesis Money's Live from the Vault program, several times has shown gold price charts suggesting that gold revaluation is already underway. If the United States is short of gold today and has been fighting gold for a half century, what would make anybody trust the U.S. government that 50 years from now it would hand you your gold in exchange for your bond? What government anywhere on the planet would be trusted to turn over gold 50 years in the future? I think you got to have your head examined to think that anybody be persuaded by that.
The broader message emerging from this environment is that the global monetary structure is quietly shifting toward a new equilibrium built around physical settlement, sovereign accumulation, and a renewed focus on tangible value. The scale of currency expansion, combined with the erosion of trust in traditional custodianship, is accelerating the migration toward assets that carry no counterparty risk. Gold is re-emerging not simply as a hedge, but as a strategic anchor for nations preparing for a restructuring of the global financial system. As deficits rise and long-term obligations become increasingly unstable, the incentive to anchor reserves to something immutable continues to grow. Meanwhile, markets that once relied on deep liquidity and seamless settlement are showing signs of systemic strain, revealing the limits of paper structures that vastly exceed physical backing. This dynamic is reshaping long-term positioning, especially among institutions that understand the importance of owning assets that cannot be diluted or defaulted upon. The ongoing adjustments may appear slow and incremental on the surface, but beneath the surface, they signal preparation for a much larger revaluation of value across the global economy. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.